thank you so much for joining us today for another session in our investor education series. Today we're going to be talking about why due diligence matters. And I'm joined by our guest, Dr. Jeff Standridge, who is the general partner of Cadron Capital Partners. Thank you so much for joining us today, Jeff.
Good to be here, Chris. Thank you so much. Looking forward to digging in.
Yeah. So why don't we start off with the most basic thing? What is due diligence and why does it matter?
Yeah, you know, the best way I can describe it is you watch Shark Tank, and I presume many of the folks watching today watch Shark Tank as well. If you were to guess about how many of the deals that get made on the set that we actually see on TV, how many of those actually follow through to someone writing a check, one of the sharks writing a check, what would you say on average?
Oh, I don't even know. 10%?
About 50% of them fall through. So it means about 50% of them get funded, right?
Wow.
So half of what we see on television never get funded.
That's
right?
wild.
Yeah. And so as a result of that, or the reason for that, is because it's difficult to make a life-changing or a tens or hundreds of thousands of dollars investment decision with a pitch deck, a lean canvas, and a 15-minute Q&A. Yeah. And that's generally what happens in most pitch calls. Most pitch calls last anywhere from 30 minutes to an hour in Cadron Capital's sense and in most venture capital sense. And so what we have to do is get beyond the surface level conversations to dig into the details of what's exactly going on in this company.
So due diligence is that investigative work.
It's the investigative work.
That a VC or an investor would be doing to find out all the skeletons in the closet.
Exactly.
So to speak.
Imagine this, when an investor is pitching, well, it's kind of like dating, right? When we're dating and we go out on our first date, we're courting one another.
Best foot forward.
Best foot forward. Make sure that our shirt's pressed and we're properly groomed and everything looks good, right? Well, once we've been dating for a while, or we get married, we become our real selves, so to speak. So that's a little bit, the analogy will break down if you take it too far. However, that's kind of what it is. So an investor pitch is a sales pitch, plain and simple. They're trying to spark interest, and so the pitch deck is created to give enough information to determine very, very quickly whether this is a potential fit or not. And then if it is a potential fit, then the angel investor, the fund managers, or the VC firm, or whomever will have a process then to dig deeper, to get in and, as you said, do the investigative work.
So then what are some examples of like deal breakers when you're doing the due diligence that you've kind of seen as examples or common things that happen that just kill the deal right off the bat?
Well, one of the first things is if we find information that's contradictory to either the information that was presented, proactively presented in a pitch, or information that was given out in response to a question. If we find information that is starkly or drastically conflicting with that or contradictory to that could be a deal killer. But I like to back up before that, because I tell all the founders that are raising capital that every interaction they have with an investor or a potential investor is an opportunity to either build credibility or erode credibility.
Yeah.
Never do you walk away during those kinds of conversations, do you walk away with your credibility exactly as it was when you came into that conversation. It's either a little bit better or a little bit worse, or it's a little bit better or it's a lot worse, right? So let's just kind of follow the process. Someone comes in and pitches to our fund. We have a conversation with them. They exit the call or the Zoom or the actual in-person meeting. The general partners and whomever else we had in the discussion with us, we actually have a conversation about, I think this is worthy of another shot or a deeper dive or some due diligence. So we then send a note or call the founder and say, hey, we're interested in going to due diligence on this. And we then generally send them a list that says, now in the early days when I was in mergers and acquisitions and what have you, we called it a data room, where it was literally a room that they populated with all of the hard copies of all of the data. Tells you a little bit about how old I am. Now it's a Google Drive, a Dropbox folder, some kind of a secure cloud-based drive. But we generally then give them a checklist of things, right? Here's all the things we want to see. The moment we send that to them, the clock kind of starts ticking with regard to their credibility. I have seen people, founders who, from the moment I give them the checklist of 8 or 10 or 12, actually close to 20 items, they have it populated in 24 hours. Huge credibility bump. I have seen founders who 4 weeks later, they still don't have everything populated, and what they do have populated is, in many instances, is not exactly what we asked for. Huge red flag. So I give feedback to all founders, give advice to them that let's get our house in order before we start going and trying to raise funds. We know what they're going to ask for. We know 95% level of confidence what they're going to ask for in due diligence. So let's create a structured data room or secure folder or something, and let's properly label it. Let's begin putting documents in it. And so if we finish a call and they want to go to due diligence, bam, I can send it to them in 10 minutes.
So if some of the deal breakers are things like not being able to populate that data room fast enough, or like you mentioned, finding out some contradictory information, what other sorts of red flags are out there as an angel investor that I should be looking for?
Sure. One of the things that I really look for happens to be the assumptions underlying their business plan, their revenue projections and what have you. You see it, again, I use Shark Tank as an example a lot of times because the general public can kind of identify that, but you see the situation where a founder comes in and says, it's a $3 gazillion market, and if I can just get 2% of it, then we'll have a so-and-so billion-dollar company. Well, and usually Mr. Wonderful eviscerates whomever says that, right? Because that is the lazy person's way to actually build a business plan. So you have to build it from the bottom up. These are the assumptions underlying our revenue plan. These are the number of clients we think we can acquire. This is what it's going to cost to acquire those clients. This is how long they will stay. This is how many will roll off at the end of every year. So there's a set of very specific assumptions. If those things are lacking, that says to me that this founder really hasn't done the work. One of the other things that I see, and we're still in the pitch stage, maybe before due diligence, but could also come out in due diligence, is how they're going to use the funds. I have seen instances where there were two founders. They were both employed full-time somewhere else. They were raising money, and they were working in this venture part-time, but 60% of the use of funds was to pay their salaries so that they could safely leave their employment and focus full-time on the business. Well, the immediate red flag there is if you're not willing to risk something, then why would I be willing to risk my own capital when the founders are not willing to risk theirs as well? So those are some situations. A situation where the chief scientific officer or the chief technology officer might be the founder, but they fashion themselves the CEO, but they really don't know how to be a CEO. And so that can create a situation where maybe they're not willing to bring in someone by virtue of the other side of the coin, so to speak, someone who's the visionary and CEO of the product or service, and they try to manage offshore developers via Upwork or Fiverr themselves, and they really don't have a technology background, so they end up spending 4 times as much as they should have. So all of those things we generally catch those in the pitch, and so they become kind of red flags or deal breakers. Deal breakers possibly, certainly red flags that we want to test on the due diligence side of the house.
And I would assume, too, that if a founder is reticent to share their information in a data room like that has to be an immediate red flag.
For sure. Yeah, I mean, you're asking someone to invest in your company and you're not willing to give them all of the data, so that's a problem, for sure.
And what's some of the common data that you'd want to have a look at?
Yeah. Well, and I brought my list here, and this is the actual checklist that we use to send to folks. So generally, most pitch decks follow a very similar format. There's a description of the problem, there's the market sizing, there's the solution that they have, there's how they're going to solve that problem with their solution, their go-to-market plan, a little bit about their team, and exit strategy, and what have you. We like to ask for additional information, like detailed company information, so bios on the founders, history of the company, any organizational charts you have depending on the size of the company, any previous securities issuance. Have you raised money before?
Yeah.
Do you have a cap table now that's got other investors on it? And if so, what were the terms of the prior rounds, and how does the terms of this round that you're asking for compare to that? Any material contracts and agreements that you have, leases, contracts with suppliers, contracts with sales agents that are trying to sell on your behalf or what have you. Any indebtedness, of course, a list of intellectual property, and what's the nature of that intellectual property? Is it trademarks? Is it patents? Is it copyrights? Is it trade secrets? What is that? Your sales, marketing, and PR. Any sales presentations, marketing collateral, any notable PR that you've had. Generally, most startup companies that are raising venture capital don't have any real assets, property or equipment, but if they do, what does that look like? A list of employees and contractors so that we can verify payroll costs as expense as a percent of revenue and what have you. Any licenses and permits. Certainly financial reports, budgets, and forecasts. I like to look at least a 3-year forecast, and again, what are the assumptions underlying those financial projections? Any litigations or claims that are outstanding or previously levied against the company. Your exit strategy, and because as a venture capitalist, we're going to make money when we exit. So what's the plan that the founder has for paying back their investors from an exit perspective? And then any additional information, research, white papers, what have you, things that just provide additional contextual information about the products, the services, the market, the company, what have you.
Okay, so if I'm the individual investor and I've got this data room that I can look at, how much due diligence should I be doing as an individual versus like relying on a lead investor or a syndicate group to like help me do that due diligence? How much of it's on me individually?
Well, it's always on you individually if you're writing a check. If you're writing an individual check as an angel investor. So it's always on you. And you can decide if you've co-invested before with the same syndicate, say you've invested alongside Cadron Capital Partners, or you've invested alongside 5 Elms or another venture fund, that you're comfortable with their due diligence and they share that due diligence with you and you're able to see that. That might help you shortcut the process, but it doesn't really take any responsibility away from you to make sure that you're writing a check into a company that you feel comfortable and confident with. But if you join an angel association like the Archangel Alliance or the 412 Angels or whomever, then you have the collective knowledge, experience, and capacity of a group of people who also have interest in this company to share due diligence and to do it collectively and collaboratively. If you invest in a fund and you're an individual investor, and rather than writing an individual check into an individual company, you write a check into a fund like Cadron Capital Partners, and your check then is going to be spread out over a dozen, 15, 18 investments. You can rely on the fact that we're going to be doing quality due diligence, but we generally also leverage an investment committee of investors to help us make sure that we don't miss anything as well.
And then, like, if I'm the one being responsible to really do my own due diligence and dig in, is there anyone like the equivalent of like a private investigator I can hire to help do some of that work?
Yeah, that's like asking someone online to build your business plan for you. I've had a number of people who come in and I ask them if they have a business plan, and they plop down a beautifully spiral-bound document with graphs and charts and beautiful fonts, and they say, yeah, this is my business plan. And I say, well, tell me what's in it. I don't have time to read it while you're here. It's got 30 pages. Tell me what's in it. And they can't tell me what's in it because they hired someone to do it for them. I'm not confident that I would ever hire anyone to do the due diligence for me, other than folks who are employed in our organization. Might do that, but as an individual angel, I would probably not do that.
And so I guess the same would apply then with the temptation to just upload something to AI and be like, hey, do my due diligence for me.
Yeah,
it
for
needs
sure.
a human set of eyes.
Yeah, I need a human set of eyes. Now, when I say I wouldn't hire somebody, I might bring in my CPA to look at the financials to make sure that I didn't miss anything. I might bring in an attorney to look at the securities documentation, a securities attorney to look at that if I'm an individual angel, to make sure I didn't miss anything there, to look at the intellectual property or what have you. But I'm directing those experts and asking questions of those experts and bringing them in when I feel like I need to bring them in. So to be fair to your original question, I don't want to suggest that I don't ever look for any kind of help.
Yeah.
If I need additional set of eyes, absolutely. Fortunately, with our fund, we generally have either our attorneys that work for us, as part of Cadron Capital Partners, not in our firm, but support our firm, or we have folks in our investment committee who are limited partners in our fund whom we can call on as well.
So it's having someone do it with you in that regard, but not outsourcing.
Not for you. Doing it with you, not for you. That's a good distinction.
All right, so we mentioned a little bit about looking into finances. What are some things that an investor should look at when they're taking a glance at a cap table?
Yeah, understanding the different classes of stock that are in that cap table. Understanding if there's any debt that's on that cap table. Understanding kind of the order of priority for any liquidation, the liquidation preferences, and so knowing whom you're investing alongside, when they invested, what were the terms of those investments in terms of valuation and what have you, and what were the classes of stock and maybe the preferential treatment for those classes of stock, and how that compares to your current investment. Most founders like to keep a relatively clean cap table, and so they'll have tranches, series of investment rounds that they will raise that'll all be at the same terms, and then another series that'll be at the same terms, and et cetera. But sometimes you can see what I would call a littered up cap table that's got friends, fools, and family, friends, family, and fools round, where Johnny put in $10,000 and Sally put in $100,000, and there was no real calculation of valuation, and so just looking and seeing how clean and tidy the cap table is a big thing.
Okay, so what happens if it's messy? How does that impact future investments or exits?
Well, the big thing, if it's messy, it really doesn't, but making sure that the terms around your investment compare favorably to prior terms, right? You want to make sure that the company is generating forward momentum and they're not going backwards, and that would be called a down round, right? So if they invested or raised a round of capital at a $10 million valuation 18 months ago, and they're raising a round of capital now at a $7.5 million valuation, okay, what's going on? This is not, you would expect it to be at a $15 or $20 million valuation the next round, not to go backwards.
Yeah.
And so, again, not necessarily a showstopper, but what's going on that's caused the backward momentum versus the forward momentum.
What are some of those financial documents that I should always request as an investor, and what do I need to be looking for in them?
So you certainly want to look at the cap table. You want to look at, if the business has been in existence for 3 years, you want to look at a 3-year income statement and a 3-year balance sheet, right? If the company hasn't been in existence, they're early stage, maybe they're not, maybe they're pre-revenue, you want to look at a 3-year pro forma, which is basically 3-year projection. Generally, it's in an income statement view, so it looks like an income statement. It's just theoretical. And you want to understand what the assumptions are underlying those projections, and are those reasonable? Do you trust them? Is the management team credible when they talk about those assumptions, et cetera?
So you mentioned, do you trust them? Like, I imagine, to go back to the dating analogy, some of that trust is kind of earned as time goes along. How do I verify the authenticity of some of these revenue and expenses on there?
Well, some of that comes with experience of being able to look at an income statement or a pro forma and run some quick ratios and say, look, you're projecting your payroll expense as a percent of revenue is going to be 13%. That doesn't make any sense in a services business. Or you're projecting it's going to be 22%. That doesn't make any sense in a technology business. Tell me about that. And if they come back with a very credible answer, based on my experience, then they may alleviate that concern by doing so. Or if they're just questions when you talk about verifying, it's seldom likely that they're going to have audited financials for a business that's been operating for 2 or 3 years. So you just have to know what you're looking at and maybe bring in some expertise in that instance of a CPA or someone, or have someone on your team who really understands financials that can help with that. If you're part of an angel association and several of you are involved, then making sure someone who's on the due diligence team understands financials and can really pick out some of those nuances.
And what should I understand about the company's current investment structure that they already have in place and their own rights?
Yeah, you want to understand what does the ownership structure look like for the founders? Mm-hmm. Do all of the founders actually have ownership? What about key employees? Do they have actual equity in the company as well? And did they earn that equity through sweat equity, or did they buy that equity? Who are other prior investors, and what's their role in the company? Again, back to under what terms did they make their investments, and how does that compare to the terms that you're requesting from me or in this round? And so those are some of the general things that you want to look at.
And then how do I confirm that some of the appropriate legal actions have taken place, like they've gotten their IP buttoned up and things like that?
Well, you can ask for copies of that documentation, and you should ask for that. In fact, that was one of the items on our checklist. Is if you have intellectual property, we want you to upload documentation, proof of that intellectual property, and what form is it in? Is it a trademark? Is it a copyright? Is it a patent? What type of patent is it? Is it a provisional patent? Is it a non-provisional patent? Is it trade secrets? And if so, what are those trade secrets? Not what are the nature of the trade secrets, maybe not what all the specific trade secrets are.
And it's all of that, all these legal documents, all the financial documents, all of that is being populated into that data room so that there's one point where the investor can go for all their info.
Ideally, yes, and I will tell you that that is an expectation that we have. Create a Dropbox folder, create a Google Drive, do something, and populate it with the items that we request so that we can go in and out of that. And so generally what will happen is we will go through all of that documentation, and we will pose questions to someone who's kind of running the due diligence for us on our team, and we will pose our questions back to him or her, and then they will shoot a note back to the founders to say, hey, we spent a little bit of time looking at the due diligence, we've got some questions we'd like to pose to you, and we will send that list of 20 questions, maybe 8 questions, maybe 25, whatever it is. We will pose that list of questions to them, and are fully okay if they want to provide those answers back via email. Mm-hmm. Sometimes they'll say, hey, kind of crazy right now, chasing investors and customers at the same time. Can we hop on a 60-minute Zoom and let us knock out those questions for you? That's reasonable as well.
Sort of liking that to like rounds going back and forth. But about how many rounds of due diligence then is typical?
It's all kind of one round of due diligence, but it could be some Q&A that goes back and forth, 1 or 2 times. It's not extensive for our purposes, because I need to also make another distinction here. Cadron Capital Partners is seldom, if ever, a lead investor. Mm-hmm. So we're generally what we call a strategic follower, in that we invest in companies, we follow larger investors into companies where we feel like that we can help them strategically with either our expertise, our connections, or those of our limited partners. So we are benefiting from the fact that they've been through a round of vetting, mm-hmm. With usually some larger lead investors, and so that helps to streamline the process as well. Doesn't alleviate us of the responsibility to make sure that we're doing our own due diligence, but it gives us some confidence that they've been vetted at some degree as well.
Well, that also means then that for the angel investor, because they're typically going to invest prior to a Cadron or something like that, they're probably going to need to do a lot more of this due diligence, because there aren't going to be other investors who have gone through this with them that they could be like, oh, this person has.
Yeah, a large portion of the time, you're right. Now, they will still take on angel investors in a round like Cadron on occasion. particularly if it's a special purpose vehicle where 4 or 5 angels come together, create an LLC, and make one investment into a company like that.
All right, so we've talked about financial due diligence. Let's talk about on an operational level.
Okay.
What should you as an investor be looking at in the team itself and in their background?
I like to look at, from the team perspective, that they are, that the founders still have control of the company, so that they own a significant portion of the company. I like to look or like to see that across the founders and the senior team members, they have most of the functionals, if not all of the functional areas covered. So finance, HR, legal, sales and marketing, operations, engineering, those kinds of things. So I like to make sure of that. I like to make sure that they've got the right people in the right roles, and I've seen a situation before where someone was the lead engineer and they fashioned themselves the CEO, but they really had a difficult time pitching the company. Yeah. And so that creates a little bit of concern from just a leadership perspective and what have you. So those are 3 things that I like to really look at from a founder team perspective. Then we start getting into the operation of the business, their business model, their operating model, their supply chain. And so, because we fashion ourselves as a strategic follower, then we generally tend to know a little bit about either the market or the products and service or the industry that they're in. So if we don't have that at the general partner level, we have that at the limited partner level most of the time. And so we can say, hey, John, hey, Sally, will you guys join us in due diligence from our limited partners base, because we know that they have experience can help us dig a little deeper.
And so then, like when we're talking with the team and finding out how they operate and all, and their different roles and functions, when they're talking about like their supply chain and their operational work, how do we verify that it's realistic with what they're projecting that they can do and perform at?
Well, some of that comes back to trust, right? And when we ask direct questions, we get direct answers. And there's not a lot of dancing and tiptoeing around. In some instances, when they name drop, so to speak, I've seen situations where we've said, could we talk to your contact at so-and-so? Or sometimes they name drop and we might happen to know that person. And so, or we know that someone is on their cap table that we might do some reference checking with as well. So it's not unlike you're getting ready to hire a service provider for your company, or you're getting ready to hire a senior executive for your company. We use all of the resources at our disposal to be able to trust but verify. With
the ever-changing world of technology that we live in, and how some things today are possible that weren't even feasible or realistic even like 12 to 24 months ago, how can investors assess whether or not a tech product is actually viable and doable?
So again, understanding the industry and understanding some of the claims that they're making, bringing in some experts in our network that we can have to help us with that. But you know what? If generally they like to tout their largest customers, so reaching out to some of those customers and asking them in advance, say, hey, may I speak to a couple or 3 of your a couple or 3 of your customers, and having them arrange that conversation so that we can test. So it's related to how we test everything else. Is we use everything at our disposal, our network and what have you at our disposal, to be able to pull this lever, to twist this dial, and to turn that knob in order to make sure that what we're getting, we feel comfortable actually writing a check behind it.
And so then in the same regard, like if you wanted to verify some of the revenue and contracts, does that go back to the data room and the referral, or is there anything more that we can be doing to verify some of those?
Yeah, so a lot of times what I will ask is, their list of customers from top to bottom. Generally we'll do some of my own calculations there. So list of customers along with their annualized revenue. So if they've got $1 million of annualized revenue, then I would expect them to provide me a list, and at the bottom of that list, as they give me the name of the customer and their annualized revenue, it's going to be at or about $1 million, right? So that I know I've got an exhaustive list. And then I'm going to begin looking at what's the concentration risk. Do three clients make up 97% of their revenue? Or is their revenue relatively distributed across those clients? And that would probably come out in a question, right? When they say they've got $1 million of annual revenue and they've got 3 household name clients, then I'd say, well, give me a list could you provide me with a list of clients in that round of questioning that I provide them back? And could you list them top to bottom based upon their revenue? And so that'd be just another way to test and verify.
And are there any industry-specific issues that investors should be aware of? When we're talking some of these big investments, we're probably talking to a tech-enabled company. It would be rather typical. Are there any industry-specific issues that investors should be aware of in that broad tech space? Or things like
for
that?
sure. I mean, healthcare, very regulated, depending on what you're looking at there. You may see that it's just a health tech solution, and so it's a software-based healthcare solution, and so maybe there's no FDA approvals that need to be. Well, if therapeutic decisions are being made based upon that software, that's not necessarily the case, and so understanding kind of the regulatory environment relative to that technology in healthcare could be one. In the retail space, retail tech and retail space, customer acquisition and the cost of customer acquisition is huge. And I'll be honest with you, I tend to stay away from those kinds of things because I don't have a good grasp on the customer acquisition side on the retail consumer-driven side. Consumer packaged goods, right? Food products. I haven't had great experience there myself. So I'm going to be much more skeptical and look much more critical where my co-general partners who've had some success and experience there may be a little more comfortable there. So we tend to generally even each other out with our experience and our background to be able to be more critical in one industry and less critical in another because of those things. But yeah, there are some definite industry level things that you need to be aware of if you're going to be an investor in health tech, retail, et cetera.
And sort of a follow-up on that, right now as we're filming this, AI is the buzzword that almost every startup either is doing or somehow finds a way to incorporate into what they're doing because they want to be relevant. Are there any specific AI-related issues that just make you wary with that as an industry and an investor, or concerns that you have?
For sure. You can slap a .ai on the name of your company or your solution and it not necessarily be an AI-enabled or an AI-driven technology. So I want to understand precisely how AI is being used, and is it a core piece of functionality or is it a novelty add-on that they've done to say that they're AI-driven or AI-enabled or what have you? And is it really AI, or are they using a very rudimentary custom GPT? So what's the nature of that AI involvement? And again, scratching below the surface there is a real requirement in that regard.
I think that's definitely great advice. So as we wrap up, one of those final thoughts I kind of want to hear from you is, if I'm an investor and I'm doing all this due diligence work, how can I make sure that I'm protected in case the founder or the startup isn't exactly either truthful or accurate in some of the information they're giving me?
Yeah. So much of it we've talked about. I do not suggest that if you're not extremely skilled in making numerous investments over your career, that you as an individual angel make direct investments into companies. I just think that is too risky of a proposition relative to the potential upside. So separating that, working with an angel association or a group of other angels where you can come together and share people's collective intelligence and collective experience, that is probably the best way to protect if you're going to make direct individual investments. The best way, even above that, is just to invest in a fund. Invest in a fund or a firm that does that professionally, and they're going to do that professionally. At the end of the day, being an angel or a venture capital or a private equity investor, you have to meet the SEC's accredited investor classification requirements. And that basically, in a nutshell, says you are declaring, I am a sophisticated investor, and I have the net worth and or the annual income to be able to afford this investment, and so therefore, by virtue of those two things, I know what I'm doing, right? And so that's kind of number one. You're declaring that you don't need protection,
Yeah.
because you can protect yourself by doing your own due diligence. And so over and above that, it's to do it with other people. Unless you are absolutely certain that you know this industry, you know this company, and you can vet them yourself.
And then how do I track and like manage and organize all this as a potential investor? You know, I'm finding all these things out in due diligence. What's the best way to keep myself organized and accountable?
So again, don't do it yourself. But what we generally do is we have a team that goes in, reviews the due diligence, creates a list of questions, poses those questions to the founders. They provide answers back. And then we write up an actual recommendation in the form of a memo. And we highlight the due diligence, and we make a recommendation to invest or not to invest. Generally, we won't write up a memo if our recommendation is not to invest. We'll just tell the LPs that this didn't pan out. Yeah. But if our recommendation is to invest, we will write a memo up, send it to the investment committee, and say, here's the situation, here's the company, here's the industry, here's the due diligence summary, and we recommend a $250,000 investment, et cetera, and give them the opportunity to ask questions, hop on the call with the founder themselves if they would like to. We coordinate that, and then once we kind of get the nod from the LPs, or we've answered all their questions, then we'll go ahead and make a decision of whether to invest or not. We have the authority as the general partners to make decisions without involving anyone in the fund. Mm-hmm. It's not a good practice. And the only time I could see us going against what the investment committee said is if we recommended an investment, the LPs or the investment committee said, yeah, we're in agreement, but then we found something before we actually wrote the check that made us want to change our minds. But even then, we would generally go back to the LPs and say, hey, look, I know we all agreed on this, but we found so-and-so and have decided not to invest, and communicated in that fashion. So it's really this collaborative process of back and forth with the founders and your LPs and your other investors, any subject matter experts that you bring in, and documenting that in the form of an investment memo.
All right. Well, thank you so much, Jeff, for your time and your insight. We appreciate all that you've done for and invested in, more than just financially, but your time and energy supporting startups across the state of Arkansas and beyond, and look forward to seeing how your expertise on due diligence can help inspire some new Arkansas investors to join angel groups and participate in funds.
I appreciate that very much. It's been a pleasure to be here, and thank you all.